hey, if you clicked on this video, you're probably interested in investing in real estate, but you don't really know what you're doing or where to get started. Well, that's cool because I'm here to help and you are in the right place. In fact, this is the start of a video series that is going to unpack effectively how to become a successful property investor for beginners. This is not going to be the advanced stuff. This is designed to help you go from 0 to 1 to get started and get some momentum on your wealth creation journey. But before we get started, you're probably thinking, who the hell am I? Why should you care what I've got to say? And why is it even relevant? Well, if you don't know who I am, welcome to my channel. My name's Goose. And over the last 4 years, I built one of Australia's fastest growing companies, specifically in the property investment space. We've bought about 1,000 properties across Australia over the last 4 years. On average, we've outperformed the market by about 50%. We've generated over $30 million in wealth for other people. And all of this has been centered around how to successfully invest in property in Australia. Now, a lot of the stuff I'm going to be talking about is going to be Australian specific. We're going to use some different language than what you might hear if you're from the US or if you are, looking at US based content, but the principles are in effect going to be the same. And my goal here is to help you to go from 0 to 1 to get you started and to get you growing. So if that sounds good to you, let's get started. And so if you're thinking about starting to invest in real estate, you got to ask yourself, why? Why would you even bother? There's a whole bunch of stuff that you can do out there. There's different ways that you can spend your money, invest your money, different things, ways you could spend your time. Why would you even bother to invest in real estate? Well, there's effectively 3 core reasons that you would want to invest in real estate: long-term wealth creation, income generation, and diversification. Now, depending on where you are at in your investment journey holistically, this may not be a diversification play because maybe you're not invested in anything else. Maybe you don't have any stocks, shares, bonds, crypto, or any of that other kind of stuff. But if you do want to create wealth over time, it is useful to have a highly diversified portfolio. Now, you do want to pick some things and kind of go deeper on those things. Personally, real estate has been the best vehicle that I have found when looking at all of the options to create wealth. Now, creating wealth is a long-term game. So this isn't a get-rich-quick strategy, but one of the benefits of real estate is that you can actually move really, really quickly. In fact, in my experience, you can move a lot faster with real estate than you can with shares or stocks, and you can do it far more safely because it's less volatile. So when you think about long-term wealth creation, what you're actually really thinking about doing is increasing your net worth and setting yourself up for a happy long-term future where you can actually do the things that you want over time. A lot of younger people that are thinking about getting started in real estate look at boomers and they go, oh, well, they've built all this wealth. The reason they built all that wealth is because they got into real estate early. And so if you're still early in the journey, don't be despondent. Actually look at what you can create over time if you can find a way to get into the market now. And trust me, it's not as hard as you think and you can do it. We've helped loads of people as well. And even if you are later in your journey, maybe you're in your 40s, 50s or whatever, and you're thinking, is it going to be too late for me to get started? Well, I've seen people build significant life-changing wealth in just a matter of 5 years. So you can do it too, as long as you have the right strategy in place and the right knowledge so that you know what you're buying, why you're buying it, to make sure you can avoid some mistakes. Now, the third piece here that I haven't spoken about is income generation. Now, income in real estate comes from rental income. Depending on the property you buy, depending on how much income is produced versus the cost of the asset is actually going to determine whether or not you have income coming from that. We'll get into a little bit more of that detail later, but that is another key reason, is effectively creating a passive income stream. Now, nothing is ever fully passive, but you can get pretty close if you know how to structure your property portfolio correctly. So that's the 3 reasons that you might want to think about investing in real estate: long-term wealth creation, build up your net worth, build up a nest egg, set yourself up for a long-term future, income replacement and income generation, and diversification of your assets in your portfolio. Okay, so we just covered the 3 reasons that you would want to invest, but there's also 3 different ways that real estate can make you money. And number 1 is capital growth. Capital growth is what happens over time when your property changes from the value you bought it to a higher value over time. Now, is it possible to buy an investment property that goes down in value? Can you buy a property that goes down and it ends up being worth less than what you paid for it? Yes, it is possible, and yes, it does happen. However, one thing I'd like to point out is that broadly speaking, over a long enough time horizon, assuming you haven't bought something completely random like a shack in the middle of a desert somewhere, there's almost a 100% success rate in property. So even in situations where people have lost a bit of value on paper in their asset, if they wait long enough, it's typically going to help rise up. Now, real estate isn't just a straight line. Some people think you just buy property and it just goes up and to the right. That is also not true. Just like any other asset, there are fluctuations and volatility in the market that can affect prices and values at any given point in time. But over the long term, real estate has an extremely high success rate, and that is where a lot of the wealth creation happens. Where you buy, for example, a $500,000 property and it goes up by 10%, that's $50,000. Or you buy a $500,000 property and then over, say, a 10 or a 12-year period, it might double in value and you've made $500,000. So if you just think about that for a second, let's say you could theoretically buy a property for $500,000 and it doubled in, say, 10 years, which is not uncommon, then you would have in effect made $50,000 a year just through the capital gains of that property, which is pretty good, particularly when you think about what it would take for you to earn an additional $50,000 just using your regular job and your regular income. Now, capital growth is great, but of course you can't spend it because it's all locked up in the assets. It's all locked up in the value. So oftentimes the only way to unlock capital growth is to do a refinance. I don't want to get too complicated on that now. We'll talk about that later, or to sell it down later on. So what you want to actually think about is how can you derive an income from your properties and from your property portfolio? And that's where rental income comes in. So this is the second way that you can make money from your assets. So what you want to do is you want to buy assets that are going to be income producing to the degree that you need it in your portfolio. So you actually may have a lot of money coming in, and so maybe generating income immediately is not the most important concern for you right now, but you need to understand that this is one of the key components because you've got the growth of the property, so that's a change in value, and then you've got the income of the property, which is how much rent you collect on that asset. Now, this applies to commercial properties, residential properties, any property, because even if you just buy a block of land, there is still a rental income component, which might be zero, but there's still a line item for how much income are you generating from that asset. Now, you may get assets which are very high income producing and produce a lot of surplus cash flow, and then there's all kinds of stuff in between as well. So that's the second way that you can make money from real estate. So first one, capital growth, second one, rental income, and the third one is tax benefits. Now, this affects different people in different ways depending on your income, what the rest of your portfolio looks like, and all of that kind of stuff. And depending on your set of circumstances and your situation, and of course, this is definitely not tax advice, there are some ways that you can get significant benefits through tax, through things like depreciation and things like offsetting your income against negative gearing. So that's the third way that you can make money from real estate. Now, real estate has its own lingo, has its own language, has its all kinds of different stuff that's really unique to it as opposed to any other asset class. And I want to talk about some of the key terms that you're going to need to know when you go on this journey. Now, we'll probably deep dive into a lot of this stuff later on in some of the future episodes that we're going to record in this series, but high level, here are some things that you need to start getting your head around. Capital gain, which is in effect the profit that you make if you sell a property for more than what you paid for it. The difference between what you paid and what you make when you sell it, that is the capital gain. The growth is the change in the value of the asset over time, and the gain is specifically the delta between what you paid and what you sell it for. Another one is negative gearing. So negative gearing is in effect if your property doesn't produce enough income to cover all of its operating expenses, you run it as an operating loss. That is called negative gearing, and in Australia there are tax benefits for that which can help you offset some of that loss in your property portfolio. Another term you need to know is equity. Equity is the portion of the property that you own versus what is owed. So for example, let's say you have a $500,000 property and you have a $250,000 mortgage on that property. That would mean that you owe $250,000 and you own $250,000 of that property. So that would be a 50% LVR, which we'll talk about in a second, but that would also mean that you have $250,000 of equity in that asset. So it's the difference between what you own versus what you owe. The own piece is the equity that you have in that property. The next thing you need to know is rental yield. So rental yield is pretty simple, but a lot of people get pretty confused by it. Put simply, it is what is the total income of an asset in 1 year divided by the purchase price of that asset. So let's say you buy a property for $500,000. Let's just say it rents for $500 per week. Okay, so you got a $500 rental income on that $500,000 property. So what you would do is you would times $500 per week times 52 weeks in a year. That would mean that you'd be generating $26,000 of rental income, but that is not the yield. The yield is when you take that $26,000 and divide it by $500,000, the purchase price. And if you did $26,000 divided by $500,000, you would end up with a number that is 0.052. Times that by 100, because then that'll give you the percent, which means that the rental yield on that property would be 5.2% rental yield. So deciding what is a good or a bad rental yield is going to specifically be dependent on what your strategy is and also what you can afford, and it also depends on the operating cost of the property. So it's important to note here that this is the gross rental yield. So the total amount of revenue that gets generated through rental income divided by the purchase price equals the rental yield. Which leads on to the next thing I want to talk about, which is positive cash flow. Sometimes it's called positive gearing, which is when you end up in a positive cash flow situation in a post-tax scenario, which is a little complex. But for the easiest way to think about this is, does the asset produce more income than it uses? So just in the same way that negative gearing is that you've got a property that produces less income than it uses, which means you have a net operating loss, positive cash flow or positively geared means that you're going to end up with surplus left over versus the expenses of the property. So for example, you may create $5,000, $10,000, $15,000 a year in positive cash flow. That's cash that you can spend. That's cash profit each and every year, which is different, of course, to your capital gain and is obviously the opposite of negative gearing. So just to anchor back to the example, let's say we've got this $500,000 property that yields at 5.2%, which we've just worked out, which means it's producing $26,000 a year in gross revenue. Cool. Now, if the operating expenses of that property, so the cost of the mortgage, cost of property management, cost of maintenance, rates, water, all of that kind of stuff, let's say, just in this example, that equaled $20,000. That would mean that you would have positive cash flow of $6,000 on that property, which would be a positive net rental yield. So that's how you can think about positive cash flow. It's the surplus cash that's left over after all of the operating expenses of the property. Another term you need to know is depreciation. So depreciation is basically a write down of the value of certain aspects of your asset that you can claim against tax. It's pretty interesting, actually. So because what happens over time is that everything in the property starts to wear out. So it could be the paint, it could be the carpet, it could be the entire building itself. And you actually get to claim that degradation of the asset as a loss against your property, which can actually represent some tax benefits and can actually provide income benefits if you claim depreciation against the operating expenses of your property. Now, speak to a tax accountant about this, make sure you get good advice, but this is to give you a general idea that there is a thing called depreciation, and it's basically a tax write-down as your property starts to wear out, and you can start to get to benefit out of that. We'll dig into that later. It's a little bit of a complex topic as well. The final thing I want to talk about is LVR, loan to value ratio. Now, a lot of people get confused by this because it sounds a little complex, but it's actually pretty simple. So if you're going to buy a $500,000 property and you're going to put down a 20% deposit, for the point of this example, we'll forget about any of the other purchasing costs like stamp duty or anything like that. So let's say you're going to put down a 20% deposit. That means you're going to put down $100,000 of cash to buy a $500,000 property. With me so far? Great. Well, that would also mean that you're going to get an 80% loan, or a loan to cover 80% of the value of the property. So you would put in $100,000 and you would go to a bank and you would say, hey, can you loan me $400,000 to buy this $500,000 property? That loan to value, which is the loan component being $400,000, to value being the $500,000 that the property is worth, would be an 80% loan to value ratio. So 80% of the property is being covered by a loan. Now, different properties may require different LVRs. So for example, it's not uncommon in commercial properties to have a lower LVR, which means that you may need to put down a 30 or even a 40 or even a 50% deposit to buy the property. But also it can go the other way as well, where you can get 90% loan to value ratio loans. And I've even heard of people getting 100% loan to value ratio loans, which basically means they haven't had to put down a deposit to buy the property, which is pretty wild. Now, there are pros and cons to all of this, and deciding what is the right LVR for you and your portfolio is going to come down to understanding your strategy and where you are at in your portfolio growth journey, because there are different ways that this could benefit you in different stages of your portfolio journey. So I wanted to keep this video relatively short. Now, what we've covered here is obviously why to invest in property in the first place, the 3 different ways it can make money for you, and some key terms you're going to need to know to become a successful investor in Australia. Now, over the next few videos, we are going to cover things like researching, finance, all of this kind of stuff that you're going to need to know in order to progress on your portfolio journey and to start to build real wealth and to create real freedom as well. So if that sounds like something you are interested in, then make sure you hit the subscribe button so you don't miss out on any single video at all. And if you want more ideas on how to create more freedom, how to create more fun, and how to create more fulfillment in your life, you can also sign up to my newsletter, the Wild Goose Chase newsletter as well. And there is a link in the description for that too. And if you found this video valuable, or if you've got any questions, feel free to chuck them in the comments. I check them all personally, and I'll be happy to get back to you as well. I look forward to helping you build wealth and create more freedom and have more fun. Stay awesome, stay powerful, and we'll see you in the next video.